Let me tell you about two people. Person A did everything the system told him to do. Saved 15% of every paycheck. Never missed a 401k contribution. Lived responsibly. He's 64 now, and he's terrified. Terrified that if the market drops 30% next year, he might have to work until he's 72. Person B started investing at 32. Nothing fancy, just $500 a month. He's 42 now, and last month, without going to work, without selling a single share of stock, his investment account paid his rent, his groceries, his electricity bill, and his Netflix subscription. Same decade, completely different outcomes. The difference? Person B didn't just build a portfolio, he built a machine. A cash-generating machine. And today, I'm going to show you exactly how to build one, even if you're starting with $0 right now. Stay with me, because the math in this video is going to change how you think about money forever. Before I show you how dividend retirement works, I need you to understand why the traditional model is broken. Here's what they teach you in school, what every financial advisor tells you, and what every retirement calculator is built around. Work for 30 to 40 years. Put money in a 401k. Let it grow. Then, when you retire, withdraw 4% per year and hope you die before the money runs out. Read that last sentence again. Hope you die before the money runs out. That is the official retirement plan of the financial industry. It is a reverse countdown to zero. You spend your 60s rationing your own savings, calculating how many years you have left against how much money you have left. That's not retirement. That's financial anxiety with a gold watch. The entire system is designed around one thing: keeping you dependent. Dependent on employers. Dependent on fund managers. Dependent on market performance at exactly the right time. Here's the thing nobody tells you. If you retire at 65 and the market crashes 40% in year one, which has happened before, by the way, you could be broke by 80. All that saving, all those decades of sacrifice, wiped out by bad timing. Dividend investing says, forget the countdown. Build a machine that generates income forever. And never touch the machine itself. That's the shift we're making today. Let me give you the simplest possible explanation of dividend investing. Imagine you buy a vending machine. Every month, that machine spits out cash. Quarters, dollars, whatever. You don't need to sell the machine to make money. You just let it run. The more machines you own, the more cash flows in every single month. Dividend stocks are vending machines. When you buy shares of certain companies, those companies literally send you a portion of their profits every quarter. It shows up in your brokerage account like a paycheck. You didn't work for it. You didn't sell anything. The company just paid you for owning a piece of it. Now, before you get excited and run to buy whatever stock is paying 10% right now, stop. That's a trap, and I'll explain why in a minute. The real game isn't finding the highest yield. The real game is finding companies that have been paying and increasing dividends for decades. Through recessions, through market crashes, through pandemics and wars and economic disasters. These companies exist. They're called dividend aristocrats. These are S&P 500 companies that have increased their dividend every single year for at least 25 consecutive years. We're talking about companies like Coca-Cola, paying dividends since 1920. Procter & Gamble, raising dividends for 67 consecutive years straight. Johnson & Johnson, McDonald's. These are not exciting companies. They are boring, essential, deeply profitable businesses that people need in good times and bad. People drink Coke in a recession. People buy diapers and laundry detergent no matter what the stock market is doing. That's why these companies can keep paying and raising dividends through literally any environment. The Dividend Aristocrats Index has outperformed the S&P 500 over the long term, with less volatility. Think about that. More stable and better returns. That's the foundation of this strategy. Okay, here's where most people check out because math is boring. But this is the most important part of the video. Stay with me. Here's the target. To generate roughly $30,000 to $40,000 per year in passive dividend income, you need approximately $800,000 to $1 million invested in quality, dividend-paying companies that yield around 3% to 4%. That's not enough to buy a yacht, but for millions of people, that's freedom. That's, I don't need this job anymore money. Now, how do you get from $0 to $800,000? Let me show you a real scenario. Let's say you invest $1,000 per month, and you reinvest every single dividend you receive, and your portfolio yields 4% annually. Year 1. You've invested $12,000. You've received about $480 in dividends. Total portfolio value? Roughly $12,500. Feels like nothing. Year 5. You've invested $60,000 total. Your portfolio is worth around $72,000. The extra is from reinvested dividends and modest stock appreciation. Annual dividend income? About $2,880. Still not life-changing. Year 10. Here's where it gets interesting. You've put in $120,000 of your own money. Your portfolio is now worth approximately $210,000. Annual dividend income? $8,400. That's $700 per month every single month without working. Now watch what happens if you increase your contributions by just 10% per year. Maybe you get a raise. Maybe you cut one subscription. Maybe you pick up a small side income. Under that scenario, by year 10, you've contributed around $180,000 total. But your portfolio is worth approximately $350,000, and you're generating $14,000 a year in dividends. Over $1,000 a month. Passive. Year 15. Portfolio worth $700,000 to $800,000. Annual dividends? $30,000 plus. Year 20. Over $1.2 million. Annual dividends? $50,000. And you never touch the principal. Ever. This is the part that makes traditional retirement look insane by comparison. The traditional model has you slowly draining your account. Dividend investing has your account growing, and your income growing, forever. When you die, your kids inherit the machine, not a depleted savings account. Let me tell you about someone I know. Call him Jim. Jim worked an average job, made about $70,000 a year. In 2015, he started investing $500 a month in dividend ETFs. First year, he made $250 in dividends, total, for the entire year. He almost quit. $250 for 12 months of discipline? That feels like a joke. But he didn't quit. Year 2, $500 in dividends. Year 3, $800. Still slow. Year 4, something shifted. He made $1,500 in dividends, and he hadn't increased his monthly contribution. The machine was starting to feed itself. Here's what Jim had discovered. Dividend reinvestment creates a compounding loop. Your dividends buy more shares. More shares pay more dividends. More dividends buy more shares. It's exponential, not linear. Years 1 through 3 feel like pushing a boulder up a hill. You're sweating, you're questioning yourself, and the progress looks invisible. Years 4 through 7, the boulder starts rolling on its own. Years 8 through 10, you're just trying to keep up with the momentum. This is called the J-curve. The strategy looks flat, or even disappointing at the start, then curves sharply upward. Almost every person who fails at dividend investing quit during the flat part. They did the quick math, saw it would take 40 years at their current pace, and jumped to crypto or options trading. They didn't understand that the math changes completely as the portfolio scales. The first $100,000 is the hardest. The next $100,000 comes faster. By the time you hit $300,000, The dividends themselves are doing a significant portion of the heavy lifting. The psychological game is the real game. I'll come back to this. Quick but critical point. Not all dividends are created equal. There are companies paying 8%, 10%, even 12% dividend yields right now. Sounds incredible, right? Double-digit returns just for owning a stock? Here's the problem. Most ultra-high-yield dividends are a warning sign, not an opportunity. The yield is high often because the stock price has collapsed, or because the company is paying out more than it earns, which is completely unsustainable. 6 months later, the dividend gets cut. The stock drops another 20%. You've lost on both ends. This is called a dividend trap, and it catches a lot of beginners. What you want instead is dividend growth. A company yielding 2.5% to 4% that raises its dividend every single year. Here's why that matters. If you buy a stock with a 3% yield today, and that company raises its dividend by 7% per year, in 10 years, you're effectively earning 6% on your original investment. In 20 years, you might be earning 12% on what you originally paid, while everyone who buys the stock today still sees a 3% yield. That's called yield on cost. And for long-term dividend investors, it's one of the most powerful concepts in the entire strategy. Focus on companies with strong, growing cash flows. Low payout ratios, meaning they're paying out less than 60% of earnings as dividends, giving them room to grow. And a track record of raising dividends consistently. Let's run the uncomfortable scenario. Because the market will crash. I don't know when, you don't know when, but it will. Let's say you're 2 years into your dividend investing journey. The market drops 30%. Your portfolio, which took you 2 years to build, is now worth 30% less. Your job is shaky. You're stressed. This is the moment most investors make the worst decision of their financial lives. They sell. They lock in the loss. They walk away. Here's what actually happens to a dividend investor in that same crash. The dividends keep coming. Even when the stock price drops 30%, Coca-Cola still sends you the same dividend payment. In fact, they might raise it, because that's what they do every single year. And because the stock price is lower, your dividends are buying more shares at cheaper prices. This is what investors call a dividend reinvestment sale. You're buying the same cash-generating businesses at a discount. 2008, the financial crisis. Portfolio values dropped 40%, 50% in some cases. People were panicking. But dividend aristocrats, most of them, kept paying their dividends. The investors who kept reinvesting through 2008 and 2009 bought quality companies at fire sale prices. By 2012, their portfolios had not just recovered. They were generating higher income than before the crash, because they'd bought so many more shares at the bottom. The crash wasn't a disaster for them. It was an accelerator. This is why dividend investing actually works behaviorally, not just mathematically. When your portfolio is paying you cash every quarter, you have a concrete reason to stay invested. You don't panic sell. You see the dividends hitting your account. You know the businesses are still running. You hold. Here's something almost nobody talks about. Once your dividend portfolio hits a certain size, around $150,000 to $200,000, you gain access to a more powerful strategy called tactical reinvestment. Instead of automatically reinvesting every dividend the moment it hits your account, you let dividends accumulate in cash. You wait. Then, when the market drops 10%, you deploy that cash. When a quality dividend stock takes a hit from some bad news that doesn't actually affect its business, you buy more. Automatic reinvestors do well. Tactical reinvestors who buy dips and deploy cash when others are panicking, they shave years off their timeline. But, and this is important, You can only do this effectively once your dividends are substantial enough to matter. In the early years, just set automatic reinvestment and let the machine build. Don't try to be clever when you're small. The compounding needs to run uninterrupted. Once you're bigger, get tact. I've been building dividend portfolios for over a decade. I've talked to hundreds of people who tried and quit, and hundreds who stuck with it and succeeded. The strategy isn't complicated. The math is clear. So why do so many people fail? Because they never rewired how they think about money. Most people see money as something to consume. You earn it, you spend it. The goal is buying better stuff, a bigger apartment, a newer car, better vacations. Dividend investors see money differently. Every dollar invested is a worker. That worker goes out and earns more dollars. Those earnings come back and become more workers. You're building an army. But every time you pull money out to buy something you don't need, you're pulling soldiers off the battlefield. Your army doesn't grow. You stay stuck. I still drive a car that's several years old. I cook most of my own meals. Not because I can't afford otherwise. Because every dollar I don't spend is a dollar working for me permanently. That mindset, from consumer to capital allocator, is the actual edge. Not stock picking, not timing the market. The edge is staying in the game long enough for compounding to do its work. And here's something the financial industry will never tell you. Once you build a self-sustaining dividend portfolio, you don't need them anymore. You don't need high-fee mutual funds. You don't need annuities. You don't need a financial advisor taking 1% off the top to underperform an index. You become financially independent from the entire system. And that, frankly, is why they don't promote this strategy. Let me give you the clear roadmap. Years 1 through 3. Build the foundation. This phase is going to feel slow and thankless. Do it anyway. Invest as much as you can. Reinvest every dividend automatically. Live below your means. Don't check your portfolio every day. Just keep adding. The goal here isn't returns. The goal is building the habit, building the base, and not quitting. Years 4 through 7. The momentum phase. This is where you'll start to feel the compounding. Your dividend income starts doubling year over year. Start increasing your contributions as your income grows. Consider diversifying into higher yield positions like REITs, real estate investment trusts, which are required by law to pay out 90% of income as dividends. This is also the phase where you'll face your first real market correction. This is where the strategy is won or lost. Stay invested. Years 8 through 10. The acceleration phase. If your portfolio is large enough, consider moving to tactical reinvestment. Start protecting your downside with more defensive positions. Begin calculating your actual dividend coverage ratio, how much of your monthly expenses your dividends cover. By the end of year 10, if you've been consistent, you should be fully financially independent or close enough to see it clearly. And remember, the income doesn't stop at year 10. Year 15, you're earning twice what you were at year 10. Year 20, 4 times. The machine keeps growing whether you're watching or not. Enough theory. Let me give you 3 specific things to do before this week is over. 1. Open a Roth IRA if you don't have one already. Vanguard, Fidelity, Schwab, doesn't matter which. Pick one. Fund it with whatever you have, even if it's just $50. Then buy a dividend-focused ETF. SCHD and VYM are 2 solid starting points. Set up automatic monthly contributions, whatever amount you can sustain. The account takes 10 minutes to open. If you're waiting for the perfect moment, that moment doesn't exist. 2. Commit to investing 10% of your income starting today. Not someday, today. If you get a raise, invest the entire raise. Don't expand your lifestyle, expand your portfolio. If you can't live on 90% of what you make right now, you have a spending problem, not an income problem. Fix the spending first. 3. Track your dividend income separately from your portfolio value. Every quarter, write down exactly how much you received in dividends. Just that number. Watch it grow. This is the number that actually determines your financial independence, not your net worth, not the total portfolio value, which bounces around every day. The dividend income, if you own quality companies, should only go up. Focus on growing that number. Everything else is noise. Here's the bottom line. The traditional retirement model asks you to work 40 years, accumulate a pile of money, and then slowly spend it down until one of you runs out. Your life savings versus your lifespan. That's a race nobody should have to run. Dividend investing flips the entire equation. You build a machine. The machine generates income. The income grows every year. You never have to touch the machine. And when you're gone, you leave the machine behind. You don't need to be rich to start. You don't need to be a financial expert. You don't even need to pick individual stocks. You just need to start, stay consistent, and let time and compounding do the work. The people making this work aren't geniuses. They're not lucky. They just started building their machine earlier than everyone else. And they didn't stop when it felt slow. Start building yours today. If this video helped you, share it with someone who needs to hear it.